Privileged to be here with a great panel, talk about what could be the most important business topic out there, this energy revolution, tumbling oil prices, impact on the economy and geopolitics, and more. We've got a great panel. I'll introduce quickly. I'll start off on my left. Far left is John Raymond, Managing Partner and CEO, Energy Minerals Group. To my immediate left, Josh Harris, who many of us know from Apollo, co-founder. To my far right, Pierre Breber, Corporate Vice President and President Gas and Midstream at Chevron, and Karen Harbert to my immediate right, President and CEO, the Institute for 21st Century Energy, U.S. Chamber of Commerce. So there's a lot to talk about. We'll dive right in. And we'll make it a little more informal and friendly, and hopefully we'll get a little debate going. The first topic let's talk about is falling energy prices. Few people predicted them, a couple hedge funds here and there and some panels, but you're always going to have some outlier make some prediction. But generally speaking, just as the shale revolution, the frackers caught everybody by surprise, so has the move recently. The question is, let's do kind of a quick view on where things are going from here, give a sense for whether we've bottomed out. Obviously, we've rallied back a little bit lately. Is it a dead cat bounce or not? Why don't we start off my far right and take a guess here. Obviously, no one knows for sure where things are going, but give us a sense of your thoughts.
Sure. Well, first I'd start to say the world got oversupplied. And so that's why prices fell. And obviously Saudi Arabia decided not to constrain production. And so the market is rebalancing through the way markets rebalance, which is through reinvestment. So with lower prices, you've seen CapEx reductions from companies, you've seen rigs be released. And so I guess I'd say the normal market mechanisms are in place and are basically going to create a tighter supply-demand balance. So we expect prices to recover. How long that takes, there's momentum from activity. There are lags in the system from when wells were drilled when oil was $100, so it doesn't happen overnight. But in time, those of us who have been in the business around have seen there have been 5 times in the last 30 years where oil prices have fallen 50%. And so this does happen, but prices do recover as markets work. And it's a capital-intensive industry where you have to earn a return. And so we're seeing the market forces rebalance right now.
I think you're seeing some of the new supply that was brought on by mainly the United States was brought onshore and was by smaller guys, the smaller independents. And those are the guys that are most impacted by this price decline. They also have the most incentive to keep producing so that they have some cash flow. And so you're seeing some of that.
Because they have so much debt.
Because they have so much debt. And so they have some obligations to continue to produce. And so we are seeing rigs come down. We're also seeing rigs come down because of efficiency, because we're getting more out per rig, which is a good story for the industry, right? And so that traditional bellwether, if it's just rigs and it's just labor that we could say things are coming into rebalance, there's some more nuances in the market that we did take account of. But we haven't, it's not over till it's over. But we can definitely see, a trend line starting on the way back up to get a much better balanced market.
The market's 2 million barrels oversupplied. If you look at some of the announced reductions in the U.S., the demand in the world, if it sort of continues to grow at 2 or 3%, should make that up in kind of 1 to 2 years. So the base case is that you get back to kind of sort of break-even economics at $65 to $70 a couple years from now. It was break-even economics for the swing producer was probably 80, and even in some of our companies, it's down to 65 or 70.
Shale companies?
Shale companies. So sort of the swing capacity, the sort of capacity that is least economic. I think when you fully cost it, half the shale is uneconomic at 60 and the rest of it's uneconomic at 50 when you fully cost it. Now, on a marginal basis, yeah, they're making money, but long run, they're not making money. So I think if you believe the base case, we should work out of this in a year or two, but a lot of that depends on Saudi Arabia. What do they want to do? Do they want to, they did what they did and they decided that they were no longer going to absorb increases in shale by reducing their own production and drop the price from 100 to 50. and the markets just ignored it. You know, so now that they're kind of half in and they've started down this path, and they are the low-cost producers, and they have a lot of staying power relative to $700 billion of, you know, kind of foreign currency reserves. You know, are they going to just allow prices to kind of float back up, or are they going to try to double down and, you know, kind of teach the markets in the U.S. and other places a little bit more of a lesson? What's going to happen in Iran? They were producing at 2-3 million barrels more than they did, you know, kind of more than they were doing today years ago. And so are they going to re-enter the economic community? What's going to happen to Iraq and Syria on the other side? Are there going to be problems with their oil wells because of all the fighting? So you've got this sort of the economic base case, but then you have a geopolitical and Middle East overview that is very difficult to predict. And so we try to keep our eye on the sort of laws of economics, which is today $65 or $70 as our beacon. But in the short run, we really don't, predicting the price of oil in the short run, whether it's going lower or higher, I think is nearly impossible for even the smartest minds.
I would echo that with the comment that the last time anybody could successfully predict the price of any commodity was never. And so we obviously all fall in that camp as well. Now, I think directionally, you know, over time you can get some things more right than wrong. Now, I think there were a couple of slides. I think there were slides number 8 and 9 that actually help to illustrate exactly, I think, what we're talking about here. Yeah, and so if you go back over the course of the past 3 or 4 years and you really look at what's happened with supply and demand, you can see on this chart the purple line where demand is growing, and then, of course, you can see the oversupply that interestingly came, the substantial majority of which came out of the United States of America. If you look at what was happening with the rest of the world over this time period with respect to supply, you had actually a decrease of about 400,000 barrels a day. All of that was offset by increases in the U.S. predominantly and some out of Canada. And so the net result of that was by the end of 2014, you had about 1.5 million barrels a day of excess supply over demand. And then I think as you flip to the next slide here, what you basically see is the glide path for production curves under different scenarios. And so in the red, you can see what was going on historically going into the early part of 2015. Had prices stayed at about $80, that's where production, you can see the blue line, that's where production was going. Now, obviously, prices didn't stay at the elevated levels, and so the question that we're all now being really forced to ask ourselves is, what does the recovery look like? Is it the what I'll call the dotted green line? Is it the dotted black line? I think the way that we look at it is that the core of the shale plays, so the best rock in the shale plays with the understanding that ultimately the geology dictates the economics. And so if you take the core of the shale plays, you can probably sustain production in the U.S. of somewhere in the 8 to 8.5 million barrel a day range, which would mean that if oil stayed at $50 by the end of this year, production in this country would probably decline by 400,000 to 600,000 barrels a day over where we were when we began the year. Now, obviously, prices have rebounded a little bit, and so with that, you start to bring on the marginal barrel from what we'll call the tier 1 areas of these shale plays. And so as that happens, you know, the market rebalances. And so does that manifest itself with a, you know, recovery to the point of a year from now? Is it 2 years from now? Where are we in June of 2016, for example? You know, I don't know. But I think directionally, it's hard to see how you're below something in the 50s. But it's also, barring some sort of a political event, it's also hard for me to see how you're something, you know, north of, you know, the 70s as well. So I think that's probably, you know, the point of a $60 to $70 range of reasonable, you know, kind of predictive outcomes, so to speak, seems like a pretty good benchmark.
It's pretty interesting just when you put it in context, like 1.5 million barrels of excess supply on a 95 million barrel market just wildly swings the market. It's pretty unusual relative to commodity markets. So I think what it tells you is that sort of a tiny bit of excess demand, a tiny bit of excess supply in the oil world because of the cost of storage and some other things has wild effects on price. And so there's just going to be wild volatility. And so I think, you know, kind of the price of oil at $50, you probably have a pretty good deal with some volatility to the upside, but it's really hard to predict.
But without this additional supply, even as small as it may seem, if we didn't have it, we would have a $150 barrel of oil. The tone and tenor of this, panel would be dramatically different about what are we doing to the global economy, right? And we focus on supply so much right now, but we actually really need to be looking, because the Chevrons of the world and all the other big investors are really looking long ball, and they're really looking at demand. And these projects take 10, 20 years to actually come online, and the profits then follow thereafter. So they're looking at where is demand in 2040. They're not looking at necessarily only next quarter. The small guys are, but these guys are playing long ball. And we look at the demand curve, and you look at, in 2040, energy demand going up by 50%, and the call on transportation fuel is enormous. So you're looking at where they're making their investments. They're not just dropping off the face of the earth. They got to replace their reserves, and they've got to plan for the longer term.
Yeah, just one quick, the shocking number to me about this entire conversation is 90% of the world's incremental supply, when oil was $100 a barrel, 90% of it came from the United States of America.
And there's another 90%. There 90% of the world's new energy demand is coming from the developing world. So we're the new supplier, and now they're the new demand, which is a fundamentally different energy market than we've ever had and are failing right now to understand.
Right. Something that not a single person would have ever predicted 5 years ago.
Except for a few frackers in Oklahoma. Let's drill down, as it were, get it? Drill down, thank you. And talk about sort of how to make money from this environment. So the hottest trade on Wall Street is to go long energy, right? Oh, obviously energy prices are going to go higher eventually, so let's get in now. There are all kinds of funds. Josh, obviously, at Apollo, they've got a big one. There are others as well. Is it too late to get involved? How does one make money now? And all this money that's sort of like with Europe a few years ago, everyone started a European fund. Does it mean that there are going to be a lot of zombie fracking companies out there and energy companies that should really go out of business? And as a result, production is going to kind of stay high and prices are going to stay low for longer than one would expect?
Yeah, I'll start. I mean, I think it's certainly not too late. So I think I would say that, I think you have to look at just volatility over the next several years. And sort of the effects of that volatility. And so when oil went from 100 to 50, everyone got excited, and some capital was raised. Certainly we raised capital. And I would say that you have to break the markets down relative to what market you're talking about. I think in the debt markets, there hasn't been a tremendous amount of liquidity to buy stuff. And so prices did fall pretty extraordinarily, and it was interesting for about 2 days. Mm-hmm. And then,
To a high yield or to a bank debt or both?
The market is really a high yield driven market. If you look at the expansion of the high, energy used to be 5% of the high yield market. You go back, over 5 years, now it's 18% of the high yield market. And the structure of energy credit is that the bank debt, if you will, is asset-based revolver, and it's really safe, really high up in the capital structure. On the high yield side, that's what drove the expansion of the shale. If you look literally dollar for dollar, $300 billion of debt was issued to finance these companies, and unfortunately, it was issued also making it even more complicated. Lots of holes in the indenture, covenant lay, lots of ways for the company to add debt on top of you, and so again, relatively treacherous. And so what the market did is when oil went from 100 to 50, it took everything down. And then some of that stuff shouldn't have gone down because it was really high quality stuff. We picked up a little bit. And then lots of job owning, lots of people on Squawk Box. And then it went right back. It went back up to a level that would indicate a return of $70 to $80 oil. So there's an inconsistency in terms of what people actually understand the price of oil, and kind of the volatility and the sort of $50 to $70 range we're talking about, and where the market is actually allowing, the price expectations that the market is allowing to be built in. So I think something like $7 billion of new debt and equity was issued, and a lot of these companies band-aided themselves.
Yeah.
And so, exactly. So I think the opportunity is definitely going, but having said that, over time, these are really Band-Aids. These companies are leveraged. They're negative cash flow. They need money. whether the price settles at 50 or 70, large amounts of what people were doing are now non-economic. And so you will see opportunity, but I think it's really time to be discerning. You can't actually read an SEC document and understand an energy company.
Wow.
So,
like a bank.
yeah, right. You really need engineers. You need local people. You need to understand, what the geology is really worth and what the cost of getting it out of the ground is. And so, a lot of people who are talking this up really are, in my opinion, doing it, not really going to be right. And you can't paint with a broad brush. But so I think patience is sort of in order. But over time, I think there's just such an enormous amount of capital needed that eventually the opportunities will be there. And so you just have to be discerning and slow.
I think you have to look beyond the E&P companies, though. I mean, we always sort of limit ourselves to, who's producing, and it's always the upstream. And I'll let the E&P guys talk for themselves, so I won't get into your knickers there. But, if you look at the United States, we have to move a lot of these molecules around. I mean, right now we're relying a lot on rail because we don't have the pipeline capacity. The midstream, the tremendous needs in the Northeast. I mean, there's a tremendous amount of pipeline that we've got to lay in this country. If they can get the permits and they can move it. A lot of that is happening at the moment. So you need to look at the United States, and we need to really think about midstream, because this stuff is going to get produced. We just need to get it to market. If they can't get it to market, why are they going to produce it, right? Which is where I think the opponents have really gone on this, have gone midstream, because if you can't move it to market, why would you produce it? And then I think on the other side, as you look around the world, I mean, we're not the only people in the energy game here, but around the world right now, more of it is offshore in really complicated places. And so the service companies are going to be in high demand going forward, because some of the easier stuff, the shale plays, onshore, we know how to do that. The shale plays around the world, the countries don't know how to do that. So both onshore and offshore around the world, the service companies' share of the market is going to continue to grow despite the rough patch. So I think you have to look beyond E&P for the real opportunities.
We're one of the largest private investors in midstream energy infrastructure in the United States of America. We're also a big investor in the upstream. And so, the way that we look at that value chain is holistically. The two are inextricably linked. To do the upstream well, you have to understand the midstream. To do the midstream well, you have to understand the upstream. And I think to the point earlier, it all comes back to the geology. Ultimately, the economics are driven by the quality of the rocks. It's the geology. And so to properly price the risk, whenever you're spending $1 of capital, you really have to understand the underlying science behind what you're doing and how you're doing it. And to the extent that you can establish positions around very good rocks, so the core of the basin, so to speak, where you're a low-cost producer, where you're producing good, high-quality reserves, and you're doing it in a strategically proximal market location. So in other words, you have a geographic advantage. Said differently, you don't have a geographic disadvantage. You end up developing franchise businesses that candidly make money regardless of whether oil is $60 a barrel or $90 a barrel, because there's a lot of equilibrium between the cost of developing the oil and commodity price. You put it in perspective, in the upstream businesses in the Permian Basin these days, well costs are down almost 30%. The Cush TI basis spread has gone from double digits down to low single digits. This morning it was a little over $2 versus, over $10 a year ago. And so when you start to run that through the calculus, so to speak, what you realize is if you own really good rocks in the Permian Basin today, you're doing okay. If you own bad rocks in the Bakken, you've got a big problem, okay? And so it all gets back to the geology, where it is, and what kind of reserves you're producing. And so in that context, I think there's still great opportunity, but it's an opportunity set that has got to be grounded in the investment principles that apply whether oil is $50 or whether oil is $100.
But it's worth pointing out, the service sector has been crushed. So, we have an investment in the service sector. I mean, literally, so cash flow goes from, whatever it is to zero, And when we look at it from our E&P, sort of our upstream businesses, literally, there's $15 a barrel of cost coming out of the margin squeeze. So, on the one hand, that's lowering the break-even economics for the U.S. And so, 65 is the new 80. But on the other hand, and I do think there's probably a cyclical opportunity in service, but, you're really now buying, you're having to make investments with no cash flow and predict, where cash flow emerges. And so it's not for the faint of heart. I do actually agree that there's probably an opportunity in services, but it's, you're handicapping something with no EBITDA. And so that's just something that's more difficult.
So that's not the first thing you're going to do in your new fund.
Well, we have a midstream platform, and I think that that's something that we pride ourselves in doing relative to others. But I think it's a relatively difficult thing for private equity to get their arms around, is handicapping, kind of 5-year average cash flow, and it's just much more difficult to predict. So the discount rate that we'll use to make investments will be higher relative to what we might otherwise be doing. But I do agree there's a lot of infrastructure need, there's a lot of midstream need. Services is probably one of the more difficult areas to be involved with, but it's there.
Pierre, you want to weigh in?
So it is a good time to invest. I mean, we're investing $35 billion. As Karen says, we look at the long game and we see the demographics of a world that needs more energy. Billions of people aspire to a higher standard of living. And it's a long-term business, and we have to go through the cycles, and we'll come out stronger. We'll be more cost efficient. We'll be more thoughtful of how we develop the resource. But I think one thing we need to come back to is the U.S. is an exciting story, and it's a great energy revolution. There's lots of benefits for this country, but it's a big world out there. It's a big world on the demand side, but it's a big world on the supply side. And so 90% of the incremental growth is true, but oil wells decline 10 to 20% a year. And so countries like Venezuela, and if you just think of the North Sea, or if you go Nigeria, Angola, there are governments that are very stressed at these kinds of oil prices, and their ability to fund their social programs and fund their share of the investments to just maintain production is one of the big challenges. So I just don't think it's very exciting here in this country, but we got to think this is a global industry.
Well, and it begs a great question, which is one that we struggle with. We don't know the answer to it, but what really is the underlying decline rate globally? We can all look in the United States, where we produce roughly 10% of the world's crude oil production, and we know it's 20, 25% given the hyperbolic nature of the decline curve of the shale plays. The question is outside of the United States of America, back to that point, 90% of the world's growth came from the United States when oil was $100 a barrel. What is going on in the rest of the world where when oil is $100 a barrel, they can't grow production? And so now you give the world $50 or $60 a barrel oil, what really is that underlying, the underlying decline curve? And we don't know what the answer to that is, but in terms of signposts to watch going forward, it's going to be very, very interesting.
So it sounds like, if I can read into what you're saying, that you're doubtful maybe that there's going to be a similar kind of shale revolution around the world in other countries.
Well, I mean, we've looked at a lot of shale rocks around the world. What you typically conclude is all the good rocks are in bad countries and all the bad rocks are in the good countries. So it gets a little bit tricky to do. And we're actually looking pretty hard at doing some things in some of what I'd call the safer foreign jurisdictions. But it's just...
But there's some complications around the world. It's not like the United States, and it goes back to property rights, mineral rights.
Yeah.
I mean, if you are in Europe, it's a very different story. If you're not going to benefit from it, why do you want somebody coming underneath your vineyard, right? I know you guys have been to Poland and looked, and it was complicated, and you look at some of the contractual arrangements. And so many of these countries, China included, which has huge reserves, has absolutely no technology to get to it, and the lack of water and infrastructure, if they could get at it, to get it anywhere. And so there are opportunities. Again, this is the long-term business. The technology will emerge, the infrastructure will get built, we will solve some of these water challenges. And so I go back and sort of push back with this is not a quarter-by-quarter business. If you're in private equity, you have different constraints and different expectations. These guys are dealing, and looking at a 30-year to 40-year planning horizon. And in that case, you're really looking at the demand for your product. And I think we underestimate the importance of demand. If you look at, we're doubling the size of the middle class in the next 10 years around the world. You look at India as a new, big, important, demand center. There are 400 million people today in India that don't have access whatsoever to any energy. And they're going to change that, and they're going to change that pretty quickly. As the largest democracy in the world that has high expectations, they have a health problem because they don't have access to electricity. They don't have access to modern energy services. And you look at the growth in China, even though that their economy is slowing, their demand for energy is not. And you're seeing more cars and other things happening. So you look at the demand curve, and that's really where there is some opportunities in the marketplace.
See, I wonder about that. We're veering off a little bit from what we talked about, but everyone assumes long-term demand is going to be growing globally. But is there some argument, and maybe I'm wrong, maybe you guys have thought about this or not, but is there some unconventional no pun intended, an argument that maybe long-term demand won't grow as fast because of things like self-driving cars, and China's not going to be growing 7% perhaps. We're becoming more efficient consumers. Even China, you know, they're shifting. They don't have the industrial focus as much, more consumer. Maybe long-term demand is actually going to be slower than we think, and as a result, prices are going to be lower long-term.
Let's level set. I mean, I think the sort of market expectation is, you know, kind of a fraction of GDP, 0.5 of global GDP. So people, I don't think, are looking for, so sort of the market's view is that, you know, demand for oil grows at 1%, 1.5%. I think that sort of is a reasonable view relative to kind of the emerging middle class on the one hand versus, you know, all of the other things that you mentioned on the other. I think a lot of it will come down to the relative growth rates of the emerging markets versus the developed economies. I mean, that's shifting a bit. And the emerging markets are slowing down, China's slowing down. I think if anything, there's volatility to the downside. I mean, I kind of agree with you. I think there's volatility to the downside, you know, on the demand. And so I don't know that if you're making bets, I mean, you know, I'm sure, my guess is that if I were in the shoes of Chevron or other oil companies, I would not want to bet on, you know, significant growth in demand, you know, greater than that expectation, because I think it's probably very difficult to predict.
Well, no, I don't disagree, but 1% on 90 million barrels is a lot. And when 90 million barrels declines 10 to 20% each year, that's a lot. So it's a big investment opportunity. It requires a lot of capital. And there are ebbs and flows between developed and developing countries, but the long-term trend of humanity is to aspire to a standard of living that we enjoy. And there are billions of people around the planet who don't come to a fraction of that. I lived in Southeast Asia. Thailand's a very developed, I mean, it's a very advanced country. They consume 1/10 of the energy the United States does. And then you go to India, and it's a fraction of that. So there's an opportunity that, whether it's tied to healthcare, it's the food we eat, it's the mobility that we take for granted, it's the comfort that we have in our buildings and our homes, it's the industry and the economic value added that comes, that we've created. Well, that's all enabled by energy. And so over the long stretch of time, that's inexorable. You just can't really get in front of that. Are we more efficient than we are? Yeah, of course. We're going to continue to get more efficient. But the billions of people who aspire for our quality of life, I think, will be stronger than that. But we're not predicating it on some sort of, this is not high tech, this is not, you know, Facebook or something. This is not a high growth industry, but it's a steadily growing industry.
I hate having this 5 to 7 year time period. I want a 30 to 50 year time period. I can only, you know, so the differences between institutional private equity and, you know, kind of longer term.
But the other part of this is how energy is being completely now embedded in our economy, right? I mean, from a production side, it used to be Texas, Oklahoma, Alaska. There was a handful of states, and now we've got more than 24 states that are producing. The other 24 that aren't producing, they're part of the supply chain. But more importantly, so we've got 50 states that are in the energy business now in the United States. But because of that,
not New York State.
Not New York State, that's for sure. But, you know, because of Wall Street, you're in the business.
Yes.
And the law firms in New York, you're in the business. So, but if you look at, okay, so we're all in the energy business, but also you're seeing industries from Europe because they've got high energy prices, high natural gas prices. They're moving to the United States. The petrochemical industry from the Middle East has moved to the Gulf. Which is just booming down there. And so you're looking at, you know, BASF, which is a German chemical company. It's really an American chemical company that has moved to the Gulf. You're looking at the fertilizer industry that has left the Middle East and come to the United States. And our farmers are benefiting from nearby cheap fertilizer, which is going to help us feed the 2 billion people we're going to add to this planet, which is not a bad thing, right? So you look at it, and we are now really becoming a much more energy-embedded economy, for lack of a better term.
Which kind of raises the interesting question of whether this falling environment of falling energy prices actually won't help the U.S. economy and consumers as much as one would think, because the energy industry is so important. You guys want to take a step?
I think there are two dimensions to it. I mean, and to the point here of the petrochem business, you know, ethane in this country is now 17 cents a gallon. Okay, that was the quoted number this morning. If you compare and contrast that with where it was 5 years ago, you know, we as a country here have become one of the lowest, if not the lowest cost point of supply for ethane on the planet, okay? Which is very different than where we were as a business 5 years ago. And so what that has manifested is huge growth in demand with the petrochem companies, be it the petrochem divisions of the major oil companies, as well as just the dedicated chemical companies out there expanding all of their ethane crackers, swapping naphtha out for ethane, et cetera, along the Gulf Coast, which means demand for ethane in the Gulf Coast is growing by almost 50% here, 50% here in this country in the past 5 years. And so we have a tendency to look at crude oil and natural gas, but the truth of the matter is it's the entire carbon chain that starts with methane, but it goes to ethane and propane and butanes and isobutanes and pentanes and hexanes and natural gasolines and alkylates. All of that has a huge impact in terms of what's going on in the economy of the United States of America. And on the margin, you're seeing massive growth in those businesses.
And huge exports of all that.
And so ultimately, right, I mean, pretty soon we're going to be having conversations here. There are a lot of proposed projects around, what's going to happen to all the C3 in the Northeast. You're going to have an excess of 150,000 barrels a day of C3 plus production in the Northeast. What are you going to do with all that C3? And in, the seasonal months, you're going to be exporting a lot of the butanes. Where's all that going to go? The answer is the Far East, okay? And so for the first time in the history of this country, we're going to be exporting a lot of C3 plus to the Far East, which again, if you tried to have that conversation with anybody who knew anything about this business 5 or 10 years ago, they would have said you've lost your mind, okay? But in fact, that's what's happening today. And so by virtue of that, you need a lot of infrastructure, number one, and number two, it is a great thing for the economy of the United States of America.
But just to answer your question directly, lower oil prices, the consumer tax cut benefit of that has helped the U.S. economy. So the sort of consensus view on that, and there's a lot of pluses and minuses, is because it does hurt the energy sector, is that the oil going from 100 to 50, and I keep using Brent, added 30 to 50 basis points of growth to the U.S. economy. So the tax, even though that's certainly going to hurt the oil business, it's good. It's still good for America. Lower prices are still good for America.
But we're not seeing it in consumer spending yet. Eventually, we will maybe.
Well, I think so I think it's lagged. If you think about it, it takes a while to go through the chain and hit the gas pumps, which is really where it hits. And then you've got a lot of other complicated stuff going on. You have the dollar going up at the same time. Oil prices have come down, and so the net of all that, at least in our view, is zero. In other words, dollar goes up, that costs 30 to 50 bips. Oil goes down, that helps 30 to 50 bips. So you've got an economy growing at 2 to 2.5%. That's kind of probably still growing at 2 to 2.5%. And there's again, oil prices and the dollar are kind of correlated a little bit. So again, this is sort of complicated stuff, but I think at the end of the day, we all should cheer when we see, notwithstanding everyone's economic interest, when prices go down, independent, we should all be happy in the U.S.
Spoken like it's a stressed investor.
It's not just at the gas pump. It's at your electricity bill. While the electricity bills are going up in this country, and they will continue to go up, and they're going to go up a whole lot more, they have gone up a lot less than anywhere else, right? And so we still have relatively affordable, very affordable, electricity, and heating oil was down in the Northeast. And now we have some inefficiencies in the system with the polar vortex in the Northeast last year. I mean, prices for natural gas, in Texas was $3, and in the Northeast it was $39. So that begs for infrastructure. But the consumer has benefited. They're not spending, but they have benefited through low prices, both at the pump and through the whole natural gas and electricity realm as well.
I thought we'd shift to exports. So obviously we're going to be exporting LNG, I think, late this year. I think Sharif and Cheniere are going to start doing that, which is an amazing idea that we're going to be sending energy from here abroad. And then now let's talk about oil exports. And Harold Hamm keeps asking for it. What are your, maybe we'll start with Pierre, what do you think about exports of oil and natural gas, and how important that'll be, how meaningful it'll be for the global markets and for our economy?
Well, we're exporting everything except crude oil right now. So we're exporting natural gas on pipes and ethane, propane. Well, ethane's coming up, propane. So refined products, we're the largest exporter of refined products. So we're exporting the things you actually consume. We're not exporting the raw material that makes the products you actually consume, and that's because of, obviously because of politics. And the revolution in the United States on energy is extraordinary, and it's created great jobs. It's added to government revenues. It's brought back manufacturing to this country. We talked about petchem facilities, energy-intensive industries. It's reduced the trade deficit. It's increasing trade with our geopolitical allies. I mean, so it's extraordinary. It's happening. And we talked about why shale hasn't happened in other places, and there's good subsurface and surface reasons. But a country like China is going to push. They're not going to give up just because it's been a little hard the first few years, because they see the advantages the United States has because of domestic energy. Every country wants to be able to have the energy to support its own economy and then export it beyond it.
It is a really politically sensitive topic, and I come from Washington, so I hear it all the time. I'm up on Capitol Hill. There's a number of folks here from the Hill as well, and a lot of us. I grew up here in California, and we had odd even days of when you could fill up. In the 70s, we put the ban on, and people have grown up in an era of scarcity, and so there's many people across the country that don't even recognize we're in an era of abundance. But for the politicians in Congress who do recognize it, and there is a growing awareness and appreciation because they look at their state coffers and they're full, is they don't want to, and I'll be perfectly blunt, they don't want to cast the vote to lift the ban and then see prices go up and be held accountable. It is a direct correlation. It is a political calculation. And so how we can inoculate that or find a way to tie that, it is inevitable we will be exporting oil. The politicians don't want to be left holding the bag. And that's the reality. The market demands it. We will benefit from it geopolitically, economically, trade imbalance-wise. I mean, there's a whole host of reasons. We've just got to get the political calculus a little more refined. And I would surmise that if we were to hold the vote tomorrow morning in the Congress, we would not succeed. We're not there yet. So we've still got some education to do, and for people to understand, they don't understand refining or mismatch, we're producing all this stuff. Why don't we keep it at home to our advantage? And for the less initiated, the less sophisticated, that's a very easy argument to hide behind. But so we do have some work to do.
I think there's a subtle distinction between the question of can you export crude oil, or can you export a barrel of light crude oil to swap it with a barrel of heavy crude oil to import it? And the issue
we're pretty close to doing that already with Mexico. So we can swap pretty soon.
What we're getting to is if you look at Cushing, Oklahoma today, and you hear a lot of stories in the Wall Street Journal, for example, about these inventory levels and what's going on in this country with inventories. We have, the last count I saw a couple days ago was about 61.55 million barrels of crude oil in storage in Cushing, Oklahoma. Now, max storage is probably about 70 million barrels with the right incentive structures and contango curves and that type of a thing. If you look historically at the proper balance up there, it's typically 30 to 40 million barrels, okay? A year ago, we had 20 million barrels in storage in Cushing. And so you think about what's happened in the course of the past year. And so if you look at the complexion of the barrels in storage in Cushing, the vast majority of those are light, sweet barrels of crude oil. And so you start to ask yourself the question of how does the inventory position in Cushing destock, so to speak, and if it doesn't, oil prices aren't going higher, so let's be clear about that, okay? And so at some point, the next signpost you're going to have to see in terms of the recovery for oil prices, the destocking of the inventories in Cushing. The question is going to be, how do you get all those light, sweet barrels out of Cushing? There are going to be two issues. What's really demand in the Gulf Coast for that light, sweet barrel, recognizing that most of the refineries in this country in the past 5 to 10 years, the Chevrons, the Shells, the Exxons of the world, worked off of a thesis that the world crude stream over time would heavy. And so they geared up with treaters and crackers, cokers, all sorts of different technology where they spent literally tens of billions of dollars modifying that refining complex, for example, in Houston, which is one of the largest in the world, to be able to treat the heavy barrel of oil. Today, you produce a very light barrel of oil by virtue of what's gone on with these shale plays, something that nobody predicted. And so the issue now is you have this huge mismatch. And so the question that I think the people in Washington would hopefully be thinking about is there's a distinction between do I just export crude oil or do I properly balance the system, meaning that if I export a barrel of light, I can import a barrel of heavy, and I can do that with countries such as Mexico, but other countries as well. Because if you did that, that becomes very beneficial to the efficiency of the refining complex in this country, and ultimately the price of gasoline that the American consumer would pay. And you're not really giving anything up in terms of export versus import because you're balancing the system.
But guys, this is wishful thinking in the context of this administration. I mean, it's not happening. I mean, like we can all go on and on about how great it is. It's not happening.
That's me. Yeah.
And truthfully, it's not even, it's not even clear to me it would happen under a Republican. It depends on the Republican.
Because of what Karen said, there's two.
Yeah, I just think politically, like no one, sort of being able to say that we have cheap gas here is massively relevant. And I mean,
but if we don't continue to produce and the prices go up and we don't have an outlet for this stuff and prices begin to go up, the consumers are going to say, what's happening here, right? I mean, we do. There are arguments to be made to go right to the consumer.
Do you think that's going to happen, or? You think we're going to lift the export ban in the U.S.?
So I'm saying if we get backed up so much that producers ultimately, the little guys go under, people stop investing, the rig count goes down more than 50% and continues to slide, production ultimately at the end of the day, no matter how efficient we are, is going to go down. And the ultimate end of that is that prices go up and people will start screaming.
This is the same administration that vetoed
And I don't
the Keystone
disagree about, I
Pipeline.
mean, this is not a president who's inclined to be supportive
I mean, if you're not going to do the Keystone Pipeline, I mean, I kind of have been down there and I chatted. It's not even close to being on the table right now.
I don't
it's not
think
even a hint of
But remember, this
consideration.
is a congressional action. It could be vetoed by the president for sure.
But that's...
But I don't think we should, write the obituary yet on the export ban, because if there are some market inefficiencies, and I agree with you on the swaps, there's already an application in to do this in Mexico.
But I think
We'd like to get that done.
my opinion is under this administration, it's not going to happen. I think if it's going to happen, it's going to happen on the next administration.
And that's around the corner. It's not so far away.
That's true. True.
Well, we're still going to do the
Deb is
spade
from
work.
Texas.
But one of the sound bites that's
Florida.
out right now is we're getting ready. I agree. The politics are challenging. But you wrote about the analog on LNG, and when your allies are saying, "Hey, we'd like some of your crude oil," and you're saying we're not going to sell it, and then when we're getting ready to lift sanctions on Iran, but the sound bite is, "But we're sanctioning ourselves." It's a long road to go ahead, but there are geopolitical arguments, there are economic arguments. They're difficult to explain to the average citizen. But, and it'll take some time, but I think there's a fair shot, especially when you think about everything else. The U.S. is supplying the world's growth on a lot of things right now. And so it's not a big leap to go to crude oil, except for politically.
Let's not forget.
We're still importing
through the
crude, guys.
recession.
We're still
let's say the
importing crude.
recession was 2007 to 2014.
Here.
Everybody could argue when the recession began and ended, or even if it has ended. But through the recession, the oil and gas industry in this country's employment went up by 38%, while non-farm employment was down 2.5%. So we could imagine what unemployment would look like if we hadn't had this shale gale. So all we have to do is, if they start turning this ship around and we stop producing, we're going to see unemployment start going back up again, because it is now so embedded in our economy. And so, if you talk to the economists in the administration, they can see some of this writing on the wall. I'm certainly sure that they hope to get through it without having to do anything, and it happens after January 2 years from now. But the reality is if there are some things that actually start getting shut in, it does have an impact, not just on the consumer, but on employment, on some of the macro indicators that made us survive the recession in a less impactful way than otherwise would have been.
Speaking of politics and geopolitics, there have been all kinds of interesting reverberations from this shale gale. Everything, Cuba and the U.S. have forged something of a relationship. Largely, I would think, because Venezuela, the oil price is down. Venezuela can't help. Cuba, all kinds of interesting things. Russia, Iran, obviously. Give me a thought on what other reverberations we might expect, we might anticipate. You're just keeping an eye out for some impact from this continuing revolution. Any you want to start, John?
Sure. I mean, our view back in November was that when Saudi Arabia made the decision they made, is they lit the fuse on 7 or 8 countries around the world. And over time, and only with the benefit of time would we really be able to tell, as they lit those fuses, what the explosion would look like. And so obviously it's the Irans, it's the Russias of the world, but it's also the Venezuelas and the Libyas and the Nigerias and the deepwater Brazils. And you go around the world, you start rattling off the names of all these countries. They're big countries that are very relevant in terms of, the global economy. And so you now see, the Iranians starting to send, the Iranians starting to receive, the Russians starting to send weapons to Iran. Yeah. And so if you're, sitting in the Saudi kingdom, it's a pretty bad fact, okay? What do you do about that? You start to see the Saudis now actually, fighting a proxy war against the Iranians in Yemen. I don't know how many wars the Saudis had built into their budgets, but those get expensive quickly. And so is that something that they, as they said, well, we're going to reduce the price of crude oil, is that something we're going to now have the budget for? I doubt it. And so, as time goes on here, there's certainly going to be stresses and strains with respect to a lot of the countries that everybody points to today. What we really think about is, well, what about these other countries. What about the Venezuelas of the world? If Venezuela tips over, what really happens? Again, supply and demand are out of balance to the tune of 1 million to 1.5 million barrels a day. It's not a very big number. And you have one interruption in one country, and we all have a very different conversation here.
I was going to say, I think, Russia, some of the economy, Russia's probably the biggest. When you go through the impacts and you really try to think about what's going to affect the global economy, I'd say certainly Russia is the largest petrodollar-based economy that, that could have an impact. They still have a lot of reserves, but they're depleting them. And then what does that do? How much of that is behind, Russia's more aggressive actions in and around the region, in and around Ukraine? Like, how does that play? Does that, do they get cornered? Do they try to act more aggressively? I mean, certainly, Saudi lowering prices, I think, was both an economic and politically motivated logical step. They are putting pressure on the Iranians. Did that lead to the current nuclear negotiations? Probably helped. So, there's no question that, a lot of the bad guys, rely on petrodollars, and petrodollars going down is certainly going to stop funding, much of their, is going to contribute to a more difficult situation for them. Whether that sort of creates a lot of hostility and aggressiveness, or whether it creates more sensible outcomes is unclear. I think it's something we really have to watch. And the other thing is just to take a big step back. Saudi is the Middle East is just becoming less important to the U.S. and more important to China. And China is becoming a more important partner to the Middle East. And I think we all just have to think about, what that means relative to, global relations. Because I think there's going to be a lot of effects, a lot of effects.
That's really interesting.
That was going to be my point. So, Josh said earlier, we're still importing oil, and that's true, but it's mostly from Canada, and the rest of the Americas. So all the flows have now moved east. And so you are seeing Russia and China in some ways get closer together, and the Middle East has to go that way. And how that plays out is an uncertainty. But what we can say is, if you have a strong America, supplying energy to allies, on balance, that's a good thing for our allies and our friends, and it's probably a bad thing for our adversaries.
I think it's important to underscore just one point there, which is, for so long we have understood the global oil market very simply, which is OPEC was supply and we were demand. And when things got tough and there was something happening around the world, we could count on OPEC, Saudi Arabia to increase supply. Well, that fundamental supply-demand equation is now broken. And you look at the OPEC, the resource-rich countries of OPEC, and they are looking to Asia because that's their next customer. And we're seeing OPEC plus Russia using and willing to use energy as a weapon, directly, whether it's politically, strategically, or economically motivated. And that is a whole new world. And then all of a sudden we wake up in 2015 and you look at Canada, the United States, and Mexico, we actually are the new center of the world's oil market. Which is causing a lot of this, unsettled nature around the world. But you take those three countries combined, the democratic molecules that we have, we are the new center of the world's oil market. And we won't use it as a strategic weapon. We will use it as a great levelizer and reduce volatility and be a reliable supplier. But that is a whole new competitive advantage for North America. And it's how we capitalize on that in the next 10 years, which is really fundamental for our three countries.
It's going to bring the East I think it has the natural sort of route of this is to bring the East together. Like, I think to sort of link Asia and the Middle East more closely relative to the relative position of where it is today.
And I would say, even though General Clark is not on our panel today because he's on a different one, I think he would say, but let's be very clear here, the United States is not walking away from the Middle East. We have so many other interests there. We're not going to just pick up and go home and let the Straits of Hormuz be patrolled by the Chinese. There's lots of interests that we have in the Middle East that go beyond energy. And so we have to be very clear to the people in the Middle East and the rulers in the Middle East that we are not retreating. We have too many other interests there, from nuclear to other issues.
You think Saudi Arabia in their core is totally comfortable with that? Are they going to rely on that? I just think that it's,
Well, it's
if you
clear
don't
that
think that
they have
Saudi
done a
Arabia
lot
is
of what they have
noticing
done
all
to
this.
test us. And to test, they want to know where our breaking point is in terms of our supply, right? Where's our price point? Where's our breaking point? So they can plan long term too. And it's clear they're looking to Israel as a reliable partner militarily if we're not going to step up. And they are doing some of these things to reduce, Iran's power in their neighborhood, which is pretty tough. But at the end of the day, we have a long history with the Saudis. We've hit rocky patches before. We're not going away, and they're making some new calculus because they've got new customers.
It'll be interesting if Hillary gets elected in 2016 because she authored this pivot to Asia idea, which is at the margin, but she seems a little more focused on Asia than the Middle East. We'll see what happens there.
We also have the reset button with Russia.
Right, that's true too. All right, we have only less than 10 minutes left. I'll ask one last quick question, and then maybe we can open it up to the audience. There's probably some time for that. We are in California, west side of LA, so let's talk about solar and wind and sustainable energy. Do things get crushed in this environment with low energy prices, or as they kind of become more efficient and their price point comes down, does it become something that they can be more competitive? Anybody want to?
I was going to say, it's sort of, look, it's something that we should invest in as a world, as a country, but it's really, with the lower prices of natural gas particularly, it's somewhat noise in the overall scheme of the energy markets, and it doesn't move the needle.
To an Apollo. So Apollo doesn't look at this.
Well, it's noise in terms of moving the price of oil or gas. It's small enough that it's generally non-economic, and so I'm not saying it's not the right, relative to the environment and all the other positives of it. I think it's a good national important thing to do, but it's to invest in and keep looking. But I just don't see it moving the needle.
I think it's got to be viewed in the context of where is that conversation 20 or 30 or 40 years from now? Because today, most of those technologies are heavily dependent upon subsidies to work. Point one, and to the point, it's single-digit percentages, small single-digit percentages of the overall supply stack. So the combination, the confluence of those two constructs, it's really interesting but meaningless in terms of what the price of crude oil is going to be for the next 5 or 10 years.
The number of carcasses of investment firms that have invested in this stuff litters the road. It just doesn't.
Government too.
I wish T. Boone was on the panel. The wind just doesn't blow.
But it has
doesn't
forced
shine.
Not hard enough.
I think it has forced a fork in the road, though, on if we want to bring more renewables into the marketplace, the approach thus far has been either to make conventional fuels, fossil fuels, more expensive, or to subsidize them. And now with this lower price environment, really the fork in the road is no, what we really need to be doing is focusing how to make these alternative energies more competitive and more.
And they are becoming more competitive.
And they are becoming more, and that's really the more efficient use of the, of investment is how do you bring those costs down so that they can enter into the marketplace and not have to rely on a subsidy that may or may not be there next year. And so that's really where the emphasis is on making them more cost effective and making them more efficient so they can free and clearly enter the market and stay unfettered in the markotplace.
Nothing to add.
All right. So we can take a few questions from the audience. I don't know if there's a mic. I see a hand. There we go.
Thank you very much. My name is Bernd Fischer. I'm the German Consul General. I almost was despairing that the last question wouldn't come. The biggest economy in the world, which is the European Union, is going not marginally, but full power into renewables. The wind is blowing, and it's the wind of change. And at the end will stand oil and gas for medicine and for plastics. We will work very fast to get a majority of cars being electric cars. We work very fast to make our houses so insulated that we don't need much energy in the winter anymore. And the most important is we will produce more and more renewable energy, also at competitive prices. And that has led in Germany to figures of 25% now. It will be 50% in 10 years, and it will be 100% in the year 2050.
But how much coal are you importing from the United States? Dirty coal. I mean, carbon dioxide emissions in the United States are falling, but they're rising in Europe.
The Germans have enough coal themselves. The American facilities, they get coal from Pennsylvania, which luckily and thanks to America we still have there. No, but what I'm going to say is renewables should have made 50% of your talking time and not just 1 minute. Sorry.
We just have.
Well, you brought up Germany. I think it's important to note, because you brought this up, we are exporting more coal to Germany today than we are China. And Germany has a very aggressive renewable energy plan and heavily relied on subsidies. And the cost of electricity in Germany is 4 times what it is here in the United States, which is why we're seeing an influx of industrial investment come out of the European Union, principally Germany, into a lower cost environment, low feedstock and low electricity. And you're building 27 coal-fired power plants today in Germany, and we're building 1, and we're probably not going to build any more.
And we're complying with Kyoto. And
We are
people
complying
never
with
thought we
Kyoto.
would be. It's all because of this natural gas shift.
And efficiency.
I didn't say anything. I mean, look, we need all forms of energy.
Absolutely.
The world's growing very fast, and each country is going to make their own choices that's going to balance economic and environmental considerations. Greater energy efficiency is a good thing. Everyone's for that. But it's a big world out there. And so we got to think about China and India and the billions of people who, renewable energy is a step removed. They need reliable, low-cost, safely developed energy. And richer countries can make different choices, but the growth is going to come from the developing world.
Yeah, I mean, it's, unfortunately, our firm has to invest in economic opportunities, and renewables are just non-economic. We have the curse of having to make a return on our investment for our investors, and the reality is, I wish I had better news. I wish renewables were economic, but they're just, by and large, not right now.
They're getting better, though, right?
Yeah, they're getting better, and again, if governments and other, private institutions want to invest in that, I think that's great. I think that the U.S. continuing to reduce coal for natural gas is going to, move the needle infinitely more than renewables will. So, and you can also the market's driving you in that direction anyway from an economic standpoint. So I think that to me is where we're spending most of our time.
And I don't doubt that by 2050, the number you referenced, the conversation is going to be different. The problem is we're in 2015. And we have to live in the current world that we're in. And, candidly, for much of the world, this country in particular, natural gas is going to be the bridge fuel to that conversation 35 years from now.
There's a question, hand back there, an eager question.
Thank you. Amy Christensen. I'm actually on the panel tomorrow about the economic implications of climate change. I'm not going to give you all my talking points now, but I did just want to note on that last point about our market opportunities for energy that China is not just the #1 investor in solar now, the #1 producer of solar. They're actually the #1 in installed capacity globally. They just surpassed Germany. So as far as where our market opportunities, our business opportunities, the Chinese aren't big on investing things that aren't economic and aren't economic opportunities, industrial opportunities for their economies. So I just might want to note that. And also that solar is creating jobs right now in the United States at 10 times the rate of the rest of the economy. So it's pretty exciting, and it is changing real quickly. I'll save the rest of the talking points for tomorrow.
Thank you. That's a good advertisement for tomorrow. Anybody? No, I'm positively. We'll come back for that one. Any last question? We have just a couple minutes. No? Okay. So a minute and a half left. We got you out in time for the next panel. Thanks. Let's give a round of applause for our guests.
Nice job.